Cap rates are an important metric when investing in commercial real estate, but use it when you shouldn't. It could kill your deal. Let's talk about it. Okay, today we're talking about cap rates. A cap rate, short for capitalization rate, is one of the most popular metrics that you're going to see when we're talking about evaluating commercial real estate. What's good about it is it's a really simple formula. It's fairly easy to understand, but what's not so simple is understanding when you should and shouldn't use it. So first we'll talk about what the actual definition of a cap rate is. We'll understand its components and what makes it up. And then once we have a good understanding of what it is and how to calculate it, we're going to talk about the really important stuff, and that is when you should use it and probably more importantly, when you should not. So put simply, a cap rate, or as I said, capitalization rate, is quite simply the net operating income of a property divided by its purchase price or its value. Now, most of us are going to be pretty familiar with what a property's value or its purchase price is. That's pretty self-explanatory. What you might not be familiar with is net operating income. So let's talk about that. So net operating income is a property's income minus its expenses, but not including its financing costs. So going back to the cap rate formula, cap rate equals net operating income, it's net income for short, divided by its purchase price or value. So with that, we can see cap rate is really just a measure of a property's net income as a percentage of its value. So to use an example, if you had $100,000 in net operating income and the property was being sold for $1 million, that $100,000 is 10% of the $1 million valuation. So in this case, the cap rate is 10%. So if you extrapolate the math out a little bit, we could see that a lower cap rate means a lower yield and a higher cap rate means a higher yield. So if we take that same property and we have $100,000 of net income and we lower the net income down to $50,000, now this deal is a 5% cap rate, which is a lower yield. And if you notice, the yield is going to be the same as your return if you buy the property cash, because again, a cap rate doesn't include financing costs. So if you bought a property for cash and it's throwing off $50,000 of net operating income and it's valued at $1 million, you have a 5% cap rate. Conversely, in the original example where the NOI was $100,000, that's 10% of $1 million, so you have a 10% cap rate. Higher cap rate, higher yield; lower cap rate, lower yield. Now at this point, this is where cap rate gets a little bit more complicated, because you might intuitively be thinking that a higher cap rate is better and a lower cap rate is worse, right? Obviously, we all want a higher yield when we're talking about investing, but it's not quite so simple. There's going to be reasons why a particular property has a higher cap rate than another property. You know, some of these things could be, it might be an older property, it might have significant deferred maintenance, a lot of money needs to be invested into the property, and as such, it's selling for a higher cap rate. It could be in a rough area of town, maybe crime's an issue in this particular area. It could be an undesirable location in terms of maybe you're in a very rural area and you have a retail or a multifamily property. You might have trouble with occupancy. In those situations, you would see a property sell for a higher cap rate than if it was located elsewhere. A final consideration for why a cap rate might be higher on one property than another could be the actual property type. For example, I'm in the multifamily space, and multifamily historically tends to trade at a lower cap rate than, say, a retail property such as a shopping center. On the flip side, a lower cap rate can also mean a more desirable property. So for example, a newer or more well-maintained building might result in a lower cap rate. Investors might pay up and accept a lower yield for a property that's either brand new or in very good condition. Other factors could be a very strong tenant base. Maybe you have a retail property with national tenants and good, strong leases. That would trade for a lower cap rate than a similar property with maybe more mom and pop tenants on shorter term leases. And then going along with what we mentioned before, the location of the property will certainly have something to do with the cap rate. So if you have a property that's either located in a city center, maybe it's somewhere in the path of progress for a growing city, or it's just in some other area such as near mass transit, those properties are typically going to sell for lower cap rates because they are more desirable to investors. Now, one of the ways us as investors use cap rates is to really look at the upside of a potential deal. So for example, I recently purchased a multifamily property at, to be honest, quite a low cap rate. And the property is not new. It's a few decades old, and the property is run down. It's got a lot of deferred maintenance. So why would I pay a low cap rate for a property that's older and needs a lot of maintenance? Well, it's because there's significant upside at the property. So because the property has rents that are significantly below market, and in this case, rents that are going for $800, $900, $1,000 a month, that should be going for $1,800 a month, I know that there's a potential value add play here, a significant one at that. So as an investor, I'm okay paying a lower cap rate, taking a lower yield up front because I know there's somewhere to go with the property. Eventually, we're going to work that net income up and significantly increase the value. However, on the flip side, if I was looking at the same property and that $800,000-$900,000 rents, that was actually what the market could bear, and that's pretty much where rents were maxed out, I wouldn't be paying anywhere near the same cap rate. The cap rate would have to be much higher because there's no upside on the property. So I need to make the deal work on day one. Whereas if you do have that upside, you may accept a lower return in the future for a much higher return down the road. So going along with all this, I want to mention that a cap rate is never the only metric you're going to use when evaluating a property. There's lots of other things that we're going to look at depending on the type of the deal, but other metrics investors use, things called IRR, internal rate of return, your cash on cash return, equity multiple. These are all different factors that have to be addressed along with the cap rate, right? A cap rate in isolation isn't going to tell you the whole story. So you can't just say something that's at a 5% cap rate is a worse deal than something at an 8% cap rate for all the reasons we just mentioned. You have to dig a little bit deeper. But in terms of back of the envelope analysis of a property, it is a good starting point. So we're going to run through a little example here. So let's say we're going to buy $1 million property. It's got $100,000 net operating income. As we discussed in this example earlier, that's a 10% cap rate. Now, if we can increase the net operating income by 30% next year, so we're going to take that $100,000 in net operating income, bring it up to $130,000. Your $130,000 net operating income would imply a valuation of $1.3 million based on a 10% cap rate. So just using the formula, we arrive at $1.3 million. However, it's actually going to get better than that. Because we raised those rents and we got that net operating income from 100 up to 130, we've obviously invested money in this property, we've improved the property probably looks better, it probably has a better tenant base, and there's a lot of good things going for it. So we may have taken a property that may have been a C+ property, and we've now made it into a B- property. Not only are we going to make more money from higher rents, as I just mentioned, we're going to have a better tenant base, it's going to be easier to rent, and all these factors. So because of that, that property is now also more desirable to an investor. So they would actually pay a lower cap rate because of the security of the asset, right? So not only did you increase your income on the property, not only did you increase the valuation based on that cap rate, you're actually going to get a lower cap rate. So if we say, hey, this C+ property is now maybe a B- property, instead of a 10% cap rate, maybe a potential buyer would now pay a 9% cap rate. So if we take $130,000 NOI, we apply a 9% cap rate on it, we're now at a 1.44 and change valuation. So with that, we can really see the power of commercial real estate and how cap rate is integral in figuring out what the potential upside of a deal is. Now, we have covered about how cap rates are higher or lower based on the specific aspects of a property, but cap rates also go up and down based on what's going on with the broader economy. So when interest rates go up, you tend to see cap rates go up, and vice versa. When interest rates come down, you tend to see cap rates come down. And the reason for that is if I'm borrowing money to purchase a property, and now my cost of borrowing is significantly more because interest rates have gone up, such as they are in this current environment, well, now I need to buy at a higher cap rate because to service that higher interest rate debt, I need a higher yield to make the same return as I was when interest rates were lower. So not only do we have the factors specific at the property, we also have the broader economic conditions that will affect cap rates up and down. So with all that together, the real name of the game here is selling a property at a cap rate that is ideally lower than the one you purchased it at, right? So if I was able to go back to that first example and buy a property at a 10% cap rate, I fix it up, I improve it, maybe over a couple years, interest rates have come down a little bit, that pushes cap rates lower. I've improved the property, that might push the cap rate a little bit lower that a new buyer is willing to pay for it. And so I might sell that 10% cap rate deal that I bought at the 9% cap rate I mentioned. So not only is the property worth more money because the property produces more money, but now I'm selling at a lower cap rate on top of that. Where you have to be careful as an investor is that you can't just assume you're always going to sell at a lower cap rate for a couple reasons. Number one, you should be conservative in your underwriting and you should plan for selling at a cap rate that is somewhat higher than the cap rate you bought at, because there are certain factors we can't control, right? When the Federal Reserve wants to increase interest rates like they have very aggressively, cap rates invariably go up. So no matter how much you improve the property, no matter how much money you put into it, you might be selling at the same cap rate or even a higher cap rate on your exit 3 or 4 years down the road. So when you're underwriting, yes, we want to sell at a lower cap rate than we bought at, but you should probably underwrite more conservatively and just be prepared to sell at the same, if not a touch higher cap rate on the exit. So where does that leave us with cap rates? You might be sitting there saying, saying, okay, I understand what a cap rate is. I understand net operating income. I kind of understand how a cap rate's important to evaluate a deal, but it can't be the be all end all metric, especially when there's, mitigating factors such as a significant value add component to a deal. But you might be wondering, what is a good cap rate? And unfortunately, it's not just a straightforward answer. And the real way to understand what cap rate should be, what's a good cap rate, what's a bad cap rate, is really just to analyze lots and lots of deals, right? So I have lots of brokers sending me deals. I do some off-market stuff where I look at deals that way. I'm on LoopNet and Crexi, constantly analyzing deals. And so I know in my particular market, I know the range that cap rates should be. So if, for example, and I'm just making this up, let's say I see, B minus, C plus class properties trading for anywhere between a 6 and 7% cap rate, and then I see a property, maybe I could buy it for a 7.5% cap rate, I should immediately be thinking, hey, this is at least worth exploring further, right? This price seems pretty reasonable. And also, why is it selling for a cap rate that's a little bit higher than some of the other properties in the area? Maybe there is that significant deferred maintenance. Maybe I'm just getting a good deal. Maybe there's something else I have to uncover there. So it's not so much what is a good or a bad cap rate objectively, it's more about what's a good or bad cap rate relative to the rest of the market, relative to the type of financing you're going to get, relative to your return expectations or the expectations of your investors. So again, it's not just this is good or bad, it's more about comparing apples to apples and trying to get an idea of a range of cap rates in your market, and from there we can determine what does or doesn't make sense. The last thing I want to leave you here with is when not to use it, right? And so you have to be careful when it's not a cookie cutter deal. Maybe the property needs a lot of work, maybe it's half vacant. Cap rates are almost never going to tell you the full story in situations like that. So like I said, always use a cap rate, understand what your cap rate is, understand what you want your cap rate to be on exit, but don't rely on it as the only metric you're using. You also have to look at things like internal rate of return, cash on cash, equity multiple, all these other factors, and then you can get a more comprehensive view of your deal and you can make better investment decisions. All right, so that's it for us on cap rates. Please like, subscribe, ring that notification bell, and please drop a comment down below. The last deal you purchased, what cap rate did you buy it at? And if you've never bought a deal yet, what cap rate are you hoping to buy a property at? So thanks again, guys, and we'll see you in the next one.